joining me alongside Caroline Woods. Hey, Caroline, let's get some losers out of the way first before we celebrate that awesome start to the week. We talked this morning about a few of the notes out, downgrade on some of the food stuff. A few of the things that were red were in that category. There wasn't much that was red today, though. But what's up with like the restaurant businesses?
Yeah, we have a few fast casual names that ended up closing down with pretty significant losses. Sweetgreen, the worst performer, down about 7% after Piper Sandler moved to the sidelines there, downgraded it to neutral, saying the risk reward for the stock is now more balanced. If you take a look, Sweetgreen shares up 208% year to date, up about 26% this month alone. So, it's seen a really impressive run up. So Piper Sandler is deciding to go neutral there. Also downgraded SHAK, which we talked about this morning, warning that of a potential worsening industry backdrop, saying the menu pricing component of this gets a little harder moving forward. So downgraded that to neutral as well. And Dutch Brothers as well downgraded the coffee chain to neutral, saying that they could be hurt by traffic to fast casual restaurants. So Dutch Brothers ended up closing down 4%. Shake Shack ended up closing down 2.5%. Should note McDonald's did add about more than 3% today after a price target hike from Evercore. And we saw notable strength in Darden today as well, up more than 4%. Didn't see any analyst activity there, but a few winners in the food category as well.
All right, Mickey D's beating the rest of the food trades like Sweetgreen, where it's like $1 million for a salad. Kind of almost as like the Walmart trade for me. It's like, Walmart of like food. McDonald's, I don't know, not bad, right? Like we're cutting costs a little bit. I feel like Sweetgreen is pretty highly discretionary as far as food places go. Am I too far off, Caroline?
I don't actually think of Sweetgreen as that expensive unless you DoorDash or Uber Eats it, and then it gets to be more like $25.
Do you put like protein on there though? Because that amps it up.
Yeah, like the chicken kale Caesar. I mean, it's not my favorite, but yeah, no, I tried to DoorDash it though, and it was $25, and I was like, okay, forget it. I don't want Sweetgreen that much. But no, I mean, Sweetgreen has performed quite a bit differently than McDonald's, so McDonald's is still negative year to date. So Evercore hiked its price target to $320 from $300, increasingly bullish on McDonald's for 2025 for the U.S. business specifically. And in the note, they highlighted the value there. So as consumers get more cost conscious, McDonald's could stand to benefit. So yeah, saw a nice pop today, now up about 8% in August.
All right, I'm going with the Walmart of food, McDonald's. This chart's looking pretty good, upswing and pretty hard over the last couple weeks. To me, that's the most interesting part of the food trade here today, with Mickey D's with a big 3% rally. I mean, that's pretty nice. All right, KG, let's talk commodities real quick, something you're watching today. Crude oil, I mean, are we like deflating the geopolitical tensions here or what?
Yeah, we are seeing a little bit of a move to the downside when it comes to crude, just because of the geopolitical tensions. Potentially a ceasefire may have been agreed upon, or at least Israel has acknowledged that they have agreed upon it. Now, we've seen this back and forth, but this is actually deflating crude right now. And then also, if you're looking at diesel or heating oil, if you will, right, where you also saw that slide to the downside, geopolitical tensions, but also this rail strike that could be taking place in Canada could also create a little bit of a slump in demand when it comes to diesel. As the trains basically won't be running. So there's pretty much two big dynamics that have taken place for the energy trade, at least in today's session.
Okay, so some of this about like supply?
Yeah. Well, so the fear of any type of retaliatory strike or an aggressive retaliatory strike is starting to dampen down a little bit. Infrastructure probably won't be in play as far as a target in Iran, and that's really causing the market to really price out a lot of that premium. And then when you're looking at Canada, the fact that they could actually have rail pretty much halted within Canada could also then build up the inventories if you're looking at diesel, because a lot of those locomotives utilize diesel in order for them to run.
Okay, thanks. That's the latter point I wanted on the supply side. Okay, cool. Let's talk to Palo Alto. As the adjusted numbers did beat the estimate, EPS 151, street expecting 141. Initial move as a swing down and then up. They're going to authorize an additional $500 million for a buyback. Never hurts to sprinkle that into the mix. Keep in mind, by the way, Palo Alto's been trending higher but hasn't hit an all-time high since the last one. So this is kind of the high-pressure report here. Shares rallying in the aftermarket. Revenues of $2.2 billion, a little ahead of the estimate, it seems like. Caroline, not a monster beat for sales, but looks like it's going to be enough. Outlook seems all right, too.
Yeah, not a monster beat, about 12% year-over-year growth, so a sequential decline in terms of that rate of change there, but did manage to beat expectations on the top line and the bottom line, as you said, with that $1.51. I was taking a look at the outlook because it seems like that's where a lot of the concerns were in terms of, worries that Palo Alto is going to have to kind of reset some expectations as they look forward. But it looks like for the full year, the revenue number is actually the Wall Street. The full year total revenue in the range of $9.1 to $9.15 billion is in line with what Wall Street was looking for fiscal 2025. Wall Street was looking for $9.1 billion there. So, and then in terms of diluted non-GAAP net income per share in the range of $6.18 to $6.31 per share, Wall Street was looking for $6.22 per share for fiscal 2025. So in line with that as well, kind of in the midpoint there. In terms of for fiscal first quarter 2025, total revenue of $2.1 to $2.13 billion. That would represent year-over-year growth of between 12 and 13%, and then earnings per share of $1.47 to $1.49. That's about 7 to 8% revenue growth. So we are seeing a nice pop on this top and bottom line beat, and certainly didn't scale back or disappoint in terms of the outlook. So I think that is going to be looked at as positive, just given that there were some concerns and even some analysts actually making some changes. I know Evercore had a tactical sell, long-term buy, but tactical sell heading into this report because they expected the fiscal year 2025 outlook to disappoint. Doesn't seem like that's the case. Yeah,
no, exactly. Not disappointing at all. In fact, their low end of their range, would be below the estimates, but the high end is quite significantly above. So if things go really well, we can imagine Palo Alto delivering a pretty nice beat relative to these expectations. Seems pretty clean. I mean, it seems like a more reliable trade maybe than perhaps it looks on the surface, KG, for a stock, that is trailing earnings of like 140, forward earnings multiple like 55. So it's it's not like you're getting this for cheap.
Yeah, and you saw a nice little bounce back to the upside here when it comes to the remaining performance obligations. That did grow by 20% on a year-over-year basis. I believe the street was looking for around 18% growth there. And that's going to be ultimately what their revenue stream could be in the future, in the next 12 months to 16 months. So if you're starting to see a little bit of a bounce back in that number, I think that's going to be a good thing to see. Next generation security, ARR actually grew around 43% year over year. I mean, that's rapid growth when it comes to the annual recurring revenue for the security business there. So that's also a bright spot. And then on the conference call, I think the only thing that could actually have them stumble up a little bit is going to be the response to questions around CrowdStrike, if they are seeing any type of activity from major players within this space that are looking to maybe integrate their back-end systems with Palo Alto Networks offerings. And if they say that they might not be seeing any of that type of flow, or they don't want to make a comment on it, I think that could be a telltale sign here. But they should have a little bit more of an optimistic view of the market. I think the last quarter was kind of a little bit mixed when it came to the commentary on the conference call, and their conference call can move the stock. They're pretty open and transparent when it comes to their business. But if you're just taking the guide right now, as well as the remaining performance obligations, it actually looks pretty decent, pretty healthy. And maybe we can actually see, some further stability for the stock and maybe upward appreciation here. If we are in a market that might see all-time highs and a market that's willing to pay those high multiples once again, this could be a stock that does benefit from that.
Okay. All right, looks like enough growth for now for the market, even though it's slowed down from its peak, still hitting 12 to 13, not bad, especially when the earnings expectations beat, because that makes the valuation a little bit more, palatable to investors. Yeah. All right. Okay. Thank you, team.